Hello, in today's video we will be talking about protected dividend income notes. What are they, how do they work, and who are they suitable for? So let's start by talking about what they are. Essentially, a protected dividend income note is a contract between you and a bank which has a period that can last for as little as 6 months or as long as 5 years. It's a fixed income contract, like a bond, which means that the bank has to pay you a dividend on a regular basis. It can be every month, every quarter, every 6 months, or every year, at your discretion. Essentially what we do is we select assets that we want to track. Normally they would be stocks, Apple, Amazon, Google, whatever. The contract with the bank will stipulate how much the bank will pay you depending on what happens to the underlying stocks. Essentially what this is a way for us to take less risk than owning a stock directly and ensure that we can make a profit even if the stock is flat or performs negatively. So if you are very optimistic about a stock or the stock market in itself, this might not be the right investment for you because you will limit, if the stock goes up 20, 30, 40% or more, you would be limited to the return that you agreed with the bank. However, if you believe that the market is kind of uncertain, overvalued, that it might be difficult for us to see profits in equities or not see really strong profits in equities because of what's happening globally at the moment, then you'd probably want to go for a dividend income note that would allow you to make a good return on your investment even if the market is flat or negative. So this is quite a broad product and a broad subject. You can do, it's very versatile. You can pretty much do anything you want with any asset you want here. So I'll try and keep focused on a few generic examples so you can gain a better understanding about how these investments work. So let's look at the main components of a protected dividend income note. Essentially, the first place that you're going to start is to identify the assets that we believe would be good assets to hold in one of these strategies. How do we do that? The same way that we would pick a stock, we would look at the financials to see if it's financially robust. We look at the market to see if it's addressing a growing market, and the technical levels of where the price of the stock is. If all of this adds up to a positive result where we would typically say, yeah, we could consider buying these stocks, then we could consider buying the stock, or if the moment of the market isn't that favorable, maybe we'd prefer to put them inside a product. So I'm going to just use a very generic example here, and let's say that we have selected stocks like Apple, Nvidia, and Facebook. Let's imagine that we like these stocks, but we believe that they should grow because they're strong companies and they have good valuations, but we're worried about the overall performance of the market holding that potential growth back, or even maybe making a negative return. So once we've decided the stocks that we want to go into the strategy, then we've got to decide the term. How long do we want to have our strategy for? That could be very short term for just 6 months, medium term 1 to 3 years, or more longer term about 5 years. Once we've established the term and the underlying assets, the next thing we need to ask for is protection. How much protection do we want to give to our strategy? You can choose here 0 protection, 10%, 20%, 30%, 40%, all the way to 50%. In this case, we have chosen to have a protection of 50% to the downside over a 5-year period. Once we know the assets that we want to own, the level of protection we want, and the term that we want to hold the strategy for, we will then send this to a selection of over 40 different banks so they can give us prices of what they would offer us in terms of a return on investment, a yield or an income. So I'm going to use another generic example. Let's imagine that all these stocks have a market price of 100. We asked for a 50% protection over 5 years, and the bank has come and said to us, we would be willing to pay you 15% a year in cash income paid monthly into your account, as long as these 3 stocks didn't fall more than 50%. If we were happy with that offer and we launched this strategy, the client would buy the product. The prices of the stocks were all trading at 100, so as long as the stocks didn't fall below 50, then the client would be fully protected and would receive their income every single month. So let's imagine that we start investing, but there are problems in the market, more global conflicts, and we just see them going down and down and down. We've dropped 10%, 20%, 30%, 40%, and now, after being invested for 12 months, we are negative 45%. You would still be receiving every single month the income of your 15% divided by 12, every single month being paid out as a cash payment. If the stocks ended up going down by more than 50%, if we went into a recession, had a COVID situation where the market got shocked, and we ended up staying down for a year or even 2 years, that is not something that we would be so worried about, as long as we believed that the stocks would be able to recover above this level of 50%. So let's imagine for 2 years the stocks were down and eventually started to come back up. As soon as they come back above the protection barrier, all of the dividends that were not paid through this period because the stocks were below the protection barrier would be paid as a lump sum here. So if this was 2 years worth of payments at 15%, my client would receive a 30% lump sum payout, which is the last 2 years of dividends that weren't paid because they were under the protection barrier. If the underlying stocks were to go down and never recover, this is where your risk is. So what is the ultimate risk with a strategy like this? Risk number 1 is that one of your underlying stocks goes bankrupt. In order to mitigate this risk, we would only ever put stocks into a product that had a mega market cap. Companies with trillion-dollar market capitalization, generally nothing ever less than a $10 billion market capitalization. It's not that those companies can't go bankrupt, but it's very unlikely, and it gives us the highest amount of security by only working with the biggest corporations in the world. If one of them did go bankrupt, you'd make a full loss on your investment, exactly in the same way as if you bought the stock and it went bankrupt, you'd make a full loss on your investment. The next risk is that the issuing bank that creates the product goes bankrupt, because who is holding your money and is paying you this income is the issuing bank. And for that reason, we only work with the world's largest banks that are generally considered too big to fail. The next risk is the risk that the stocks go down and go below the protection barrier and stay down all the way to the maturity of the product. In this case, what would happen? Let's imagine we invested $100,000 in this strategy. You would have received in year 1 your 15% paid, and in year 2 you would have also received 15%. But in year 3, the stocks went under the barrier and never recovered. By the time you get to the end of the contract, the bank will cancel the contract and look at where the stocks are. If they were negative 49 or 50%, you would get 100% of your investment back. But if they were negative 55%, below the barrier, you would cancel the contract and receive the stock in your portfolio. So a key part of these strategies is you should never do a strategy that you don't like the underlying company or the underlying stock, because if in the future they did badly, and you ended up owning that stock, you might not want to own that stock in your portfolio. So only ever have strategies where, in the worst case scenario, you say, if Apple's trading at a 55% discount, I'm more than happy to own it because I believe the company is strong and it will grow and it will recover. So essentially your risk is exactly the same as buying the underlying stock, because if the underlying stock went down by 50%, you would also be in exactly the same situation. So in this scenario, when the product matures, we would have a calculation. My client bought the product for $100,000. The price of the shares was 100, and therefore the client owns 1,000 shares of this company. We end up under the barrier and Apple is down by 55%. You're going to receive your 1,000 shares that you had exposure to, but instead of them being worth $100 a share, they're now worth $55 a share. You can choose to sell those stocks, or you can hold on to them and wait for the company to recover. This is better than buying stocks when the stocks go down. Why? Because in this scenario, the client picked up 15% here and 15% here. So they made a net $30,000, but lost $55,000. So compared to the person that bought the stock, held for 5 years, and lost 55%, our client would have only have lost in that scenario 25%, putting them in a much better situation than if they held the stock. If the stocks go up in value, you will not participate in the growth. So like as I said before, if you think these stocks would grow by more than 15% and you're very confident about that and you're not worried about market risks, you should just buy the stocks. However, if you want to own good quality assets, have a lot of protection against market risks, and try and guarantee some double-digit returns, this makes a lot more sense. So this is the risk where we've got bonds and fixed income here and stocks here. This is like a hybrid which turns stocks into a fixed income product. Okay, so it's more potentially more volatile than a standard kind of bond, but less risk than buying an individual stock. Yet the returns tend to be very similar to what you would expect from stocks. Typically, within these products, we also have what is called an auto call feature, an early maturity feature. The early maturity feature will typically happen on month 3, 4, 5, or 6. So at the start of the product, no matter what happens to the underlying stocks, you're going to receive your income every month for the first 3 months. On the 3rd month, if all the stocks are at the same price that we bought them at, or better, then the bank will cancel the contract, you'll have received your 3 dividends, and you'll get all of your money back. At that point in time, you would probably contact me and say, Charles, I've received my money back. What should we do? Should we repeat the same strategy, or is it time to do something else? The reason that we put the auto-callable feature into these products is because at some point in time, the market will change and it will be a place that's attractive and we want to buy stocks. We believe interest rates are coming down, wars are ending, global harmony is returning, and it's a great situation for us to buy stocks. We could probably be looking at 20, 30, 40% returns if we pick the right stocks. We don't want to be locked into a 5-year contract giving us 12 or 15% if suddenly there's opportunities for us to be in the market. So if the market goes up and it looks like it's going to be sustainable for growth, we want to automatically liquidate everything so we have that option. However, sometimes the market goes up, but really the conditions haven't changed. We get liquidated, we look at the market and say, no, you know what, I don't want to be in the market, I'm going to continue doing these strategies. So there is an early maturity feature, and to be honest with you, normally I'd say 90% of our products don't reach the final maturity. They typically mature way before the end. You also have liquidity where you can sell the strategy whenever you want for the market price. So even if you have a 5-year term, you're not locked in for 5 years. So essentially this is a great way for you to be able to get consistent return in flat or negative markets, get equity-like returns, but with a significant protection to the downside, and diversify your portfolio in a good way and have consistent monthly cash flow. Now let's take a look at some examples. So first of all, I'm going to start with a short-term strategy. short-term strategies are typically used around technology stocks where you have a lot of strength in the short term, like in the case of artificial intelligence, where you can kind of see the next 6 months looks like the trend will continue. You wouldn't necessarily know what's going to happen in the next 5 years. And the problem with tech companies is they're typically always overvalued. So it's not nice holding on to an asset that looks overvalued for a long period of time. So in this case, we look at a product that we did in September 2023 and had a maturity for May 2024. Or sorry, we did October 2023 for May 2024 final maturity. We selected AppLovin Corporation, Supermicro Computer, and Salesforce. We did our evaluation and saw that these companies were potentially going to show very strong returns. And if you look at the share price, AppLovin, when we did this, AppLovin was 39, Supermicro was 26, and Salesforce was 203. If you look at where those share prices are today, I think you'll be quite surprised of how much growth that they actually displayed. So our analysis was excellent. We said to the bank that we'd like to have a protection of 40%. So when we issue our contract with the bank, we know exactly what our price is on each one of the stocks and exactly where our protection barrier is on the price of each one of the stocks. So if any one of the stocks went below these values, we would not get paid our dividend. And if at maturity it was below these values, we would be receiving the stock at that depreciated level. But as long as the stock has, even if it's lost money, as long as it hasn't lost more than 40% and the stocks are above these prices, then we will continually get paid our 19.68% a year. This was paying out 1.64% and was projected to run for about 7 months. So in this strategy, what happened? We started our investment. The maturity was supposed to go until October. We had the opportunity for an early maturity from the second month onwards. If the stocks were at the same price, 100% of the price that we paid. So as long as the stocks were at this price or better, from the second month on, the bank could stop the contract and deliver the capital back to our investors early. If not, if the stocks were down, then they would keep paying the dividend. And by the maturity, as long as the stocks hadn't fallen more than 40%, our clients would still be returned their full capital and have made a return of 19.68% annualized in dollars. What happened here? In the first month, our client got paid 1.64%. In the second month, one of the stocks was down by 3%. So it didn't mature early, it paid out the dividend and continued, but then on the third month, all the stocks were positive and therefore the bank returned the capital in full to our client. Over a period of 3 months, the client made 4.92%. At that time, the client said to us, should we do this again? We said, yes, we could do it again, but maybe we want to avoid Salesforce because it's already appreciated by 30%. So the chance now for it to drop 40% is a lot higher than it was before at that lower price. Now let's take a look at a different strategy, not in the tech space, but more in the kind of value investing space, the industrials like oil and gas, gold mining, very solid, long companies with a lot of longevity in a good moment of the market, but don't quite show the growth that you'd get from things like tech stocks, but also don't have as much risk and volatility as tech stocks. So we've done this strategy on 4 occasions. In this example, we looked at 4 of the biggest gold mining companies in the world: First Majestic, Pan American, Newmont Mining, and Anglo Gold Ashanti. We asked the bank for a protection of 40% to the downside, and the bank was offering us a return of 15.42% per year on our investment in dollars. We started this one in June, July of 2024, and it has a maturity of December 2027. So around a 3-year investment horizon. What happened with this strategy? we had a potential for early maturity after the third month. In the first 3 months, our clients got paid 1.285% per month in cash dividends. It could have matured early, but First Majestic was now down by 20%. So above the protection barrier, pays the dividend. Below the initial price, won't mature early. The next month, First Majestic had recovered very quickly to negative 3%. And by the fifth month, all the stocks were positive, and therefore the product matured. In this case, because the stocks hadn't really changed too much in price, the clients decided to reinvest and do the same strategy again. As you can see here, we've done this one multiple times, but sometimes we change the stocks because some stocks appreciate too much and then they pose more of a risk. So this one we launched paying 12.24%, then we launched this one at 11.1%, this one was paying 15.42%. These all matured and matured and matured, and we repeated and repeated and repeated. This one right now is available to investors. So if you, like me, see that gold is a very good asset to hold in your portfolio, this could be a very interesting opportunity for you to invest. We have First Majestic, Newmont Mining, Pan American Silver, and Anglo Gold Ashanti, paying 14.1%. It has a 4-year term, but history will tell us it's unlikely it will run to its maturity, and it will probably mature within 6 to 12 months' time. Here is a strategy that we did back in 2022 for a 5-year term on Unity Software, Roblox Corporation, and Meta. We were looking at companies that were involved in metaverse for the potential of growth, but didn't depend on the metaverse for their growth. So we selected these 3 assets. We got a fantastic return from the bank at 25.2% in dollars with a 40% protection to the downside. In this one, you can see the impact of having a memory feature. We launched the product on the same day the dividend should be paid, so the first dividend wasn't paid but was paid in a double dividend the next month. The stocks were up above the protection barrier for the following 3 months, but then one of the stocks fell by 42.5%. Facebook was down by 42.5%, so it was 2.5% below the protection barrier, and therefore the dividend wasn't paid, but the client remained invested. The next month, it was down just by 0.15% below the barrier, no dividend paid. But because of our dividend memory feature, no matter how long you go not receiving dividends, as soon as the stock comes back up above the protection barrier on the dividend date, you'll receive all the missed dividends. So again, this product was supposed to run to 2027, but because all of the stocks ended up in positive territory, our clients basically had 1 year worth of investment, and they made 27.3% and returned all their capital. So it's very easy to talk about when things go right, but what happens when unexpected occurrences happen and things go wrong? Let's look at what we did back in 2019. 2019 was the end of Brexit. Finally, the 3 years of uncertainty had come to an end and Brexit was actually happening. This meant that the UK's stocks over the previous 3 years had lost a lot of value through political uncertainty, and now we expected the value to recover. So we selected 4 of the biggest companies in the United Kingdom: Vodafone, British Telecom, WPP, and Centrica, which is British Gas. We managed to get a 14% return, and we had a maturity to mature in 2025. So this is a 5-year product. If we look at what happened here, it was paying out very well, 1.167% a month, every month, until an unexpected event, COVID. Obviously, UK got hit very hard. The stocks were down below our protection barrier, negative 53%, and clients were not getting paid. That happened for 12 months until we came to January, where the stocks started to recover. Even though the stocks were down by 40%, our protection barrier was 42%, which meant that we went back up above the memory feature, and our clients picked up the whole year's worth of dividends that they had missed. This is very important when we talk about the psychological impact of investing and the psychological and emotional stress that you can go through with market volatility. If you had bought these stocks in 2019, when COVID hit and the UK was in a mess, you might have had an emotional reaction and panicked and sold those stocks, saying, oh my God, this looks terrible, let's get rid of them, and realised a loss of around 50%. If not, you would hold on to those stocks, and every time you looked at your statement, you would feel bad. Oh, my money's lost. I'm losing money to inflation. I'm just waiting and waiting and waiting for my assets to recover. But as we can see, since 2019, these assets have not really recovered. So the emotional stress and the opportunity cost of having your money stuck in bad assets can lead you to make emotional decisions, realizing losses, or have frustration and negative emotions because of the problems in the market, which came from a completely unexpected event. My investors, however, had a very different experience. If your product is below the barrier, it makes sense for you to wait because you're accumulating the dividends that are being owed to you. So in this case, even though clients weren't necessarily feeling that great about the situation, they felt a hell of a lot happier when they got paid out their 12%. And if they add it to the other 9 payments they had here, they've now had over a 20% performance. So even if the stocks were down by 40, their actual net loss was only 20. But at this time, when they go above barrier, they want to stay because they start receiving their dividends again. What happened? We had the variant of Delta. It pushed the market under again, came back up. We had the memory feature, volatility down below, back up again. At any point in time, the clients could sell. So there was a point in time where I recommended clients to sell because I didn't like what was happening in the UK, and they would have left with just a 5% loss, but they'd already generated almost 40% in income. So that's the benefit of having liquidity on these strategies, that you can sell them any point in time that you want to for their market price. In the long run, if we look at what happened here over the history of the product, if you had bought these stocks back in 2019, you would still be looking at terrible performance and a net average of losing at least around 30%. My clients in the same situation have actually made 73% from assets that have really just done nothing. So this is why I think this is a very interesting strategy for most people in this particular point in time in the market, where we have a lot of risk, a lot of uncertainty, and a lot of companies that are highly valued because of essentially money printing, propping up valuations and not real demand. I hope you found this interesting. You'll probably have questions and doubts. If you do, please call me, contact me, email me, or arrange a meeting so we can go over them together. Thank you very much.